What's up YouTube? It's Todd Horst here with Tasty Tracker, and today I wanted to go over short verticals. They can also be called spreads, and why I love them. The past two episodes I did iron condors and iron butterflies in one episode, and then in the other episode I did covered calls. I touched on cash secured puts in there, and then the wheel. And both of those I had in the title that I didn't really like them. So now I'm doing one that I do like, so this is a little bit more fun for me. So what I'll cover, entering and exiting, the risk associated with them, who it makes sense for or when it makes sense, and why I love them, general recommendation, and some conclusions. So getting started, you should watch my 16th episode, Options 101, to get a background on calls and puts and selling to open. That is the primer for this episode, so you'll understand the terminology and the context, and it will help this make a whole lot more sense if you start over there. This isn't the way most people get started because it's viewed as a little bit more complicated. The potential of getting assigned is scary for people, so that's one thing they don't like. It's got multiple legs, that can be scary, and just generally speaking, when you're buying a call or buying a put, that's more intuitive, I think, to some people once they think, oh, buying a call is going up and buying a put is going down. That's all you really need to understand to get started with that. And when you're selling these spreads, it's the exact opposite. So if you're selling a call spread, you want the stock to go down, and if you're selling a put spread, you want it to go up. And we'll dive into the ramifications of that, but before we get there, the next bullet point here is that it requires a higher approval level because it requires margin. And even though the broker knows that you sold the call or put, let's just start off with calls. Say you sell a call closer to at the money, and then you buy one that's further out of the money as protection. This defines your risk, which is really nice. Even though your broker knows that you are only at risk for the difference between those two strikes, say it's $5 wide, then you would be responsible for $500 minus the credit that you received. Typically, that's going to be, we'll say $150 for a $5 wide spread. So you're going to be responsible, potentially lose $350. You're risking $350 in order to make $150. But no matter what stock that is, as long as it's $5 wide, that is what you're looking at, something around $350 risk versus $150 reward. So it could be on a stock that's Amazon or something like that, where it's a couple hundred to more than $1,000, or it could be on some $50 stock like AMD. So if you think about it, the Amazon ones that you sold and bought are way more expensive than the AMD ones just because of the underlying price. And since the broker's only making you be responsible for the difference there, they still have to essentially foot the bill for those options up front. And so that's why in a cash account, they're not going to allow you to sell spreads or naked options unless you have the cash to back it up. But typically speaking, a cash account is limited to like cover calls or buying calls and buying puts. And the difference here, the reason it requires margin is what I just said there, that those options are way more expensive than what the broker is charging you. So you can think of it as kind of leveraging on top of leverage, even though you're not at risk really, especially if you do things properly. And then one other caveat there, I should say, anytime you have any questions, you need to contact your broker, and that is the reasoning for going with a better broker. So Robinhood is harder to get a hold of their support, but at the same time, they are a bit more proactive with their risk management team, which is both a good and bad thing. Obviously, you'll hear a lot of horror stories where the risk management team acted on somebody's behalf when they didn't want them to. But on the flip side, they'll also save a lot of people a lot of money. Of course, you're only hearing about the horror stories, there are plenty of times when the risk management team makes the correct decision both for the broker and for the individual. But someone like Tastyworks, which is who I use as my main broker, links in the description if you feel like it. They're very, very accessible 24/7. So I've contacted them on the weekend plenty of times, and I typically do IM. I don't do email support, so the reaction is much, much quicker than something like Robinhood. So you do get what you pay for, and I think as a beginner, even though Robinhood's interface is really easy to use, you actually need that help, that assistance from the broker when you're getting started in understanding. Obviously now I consult with them much, much less than when I started. So ironically, it's better for me, or I could switch to Robinhood easier than what a beginner could because they need that backup, if that makes sense. So as always with these videos, I'm recommending Tastyworks to just learn the strategies. Even if you don't want to use them as a broker, you can sign up. You don't have to deposit any money. And then they have a strategies button where you can click it and click on the strategy you want, and it will fill it out for you. And it makes understanding how to set them up and how they work much, much easier. And I will show you how to do that once we get into it a bit. And unlike Iron Condors, setting up a vertical on Robinhood is more cumbersome than it is on Tastyworks, but it's not the end of the world. It's definitely doable in a relatively short period of time. So I think it makes more sense certainly than an Iron Condor, but more sense to continue to stick with Robinhood if that's the platform you're on to do verticals, assuming you have the appropriate approval level. So that was a long intro. And here I have a picture of Tastyworks. I'll go over all the pieces. This is actually an Iron Condor, but an Iron Condor is simply made up of two verticals, a put vertical and a call vertical, both being credits. So if you want to divide this in half right in the middle, that's exactly what we'll be looking at. So we'll go over this again. Apple's the ticker. This little e means that earnings is coming up, at least the time I did the screenshot. The IV that's implied volatility is 22. You can click on the strategies button and it'll pop out. And again, I'll show you this in a bit, real time. But that will give you all the different strategies. Here's your expiration. If it needs to be, if there's a lot of scrolling, it will do this little split window for you to make it easier. The strikes are down the middle, and you can see the days to expiration here. And then I have the percentage in the money, which is what I like to use. Your broker might only have delta. I know like Robinhood only has delta that you can use as an approximate. And one last thing I guess I should say about the previous slide. I not only should you use Tastyworks to learn these setups, the strategies, but you should also use it to actually set the position up. And then once you figure out where you want to set your strikes, what strikes you want, and what kind of credit you would get and stuff, then transfer that over to Robinhood to actually execute the order over there. But anyway, okay. So down here we have the call side. Most brokers have this inverted, like if you use Thinkorswim or Tastyworks here, the calls are down here, so you can see it's increasing as we're going down, and then the put side is up here. So when we're talking about a credit put spread or a credit put vertical or selling a put vertical or short put vertical, those are all synonyms to say that you're receiving a credit when you open up the position. So you're selling to open, which means you have to do the opposite when you close. So it's a buy to close. So, right. Okay, so up here we're selling the 350. That's closer to at the money, which is 380 right here. And then buying the 345. And because this is an Iron Condor, I had it set up at 15%. But typically when you're doing verticals, you're going to want to go somewhere around 30 or 40% in the money. That will give you a 60 to 70% chance of success. Certainly you can still have a string of losers, but the idea being that when you play hundreds and hundreds and hundreds of these positions, the law of large numbers averages out to say that that's what your win rate will be that, or actually better if you manage your winners accordingly. This also, I should state, the percentage in the money is at the time of expiration. So it might be losing the entire way through, and then in the last week come back into your favor. So it doesn't mean that it will instantly be green if you choose a, something up here, excuse me, that's an 80% success rate. That could, the stock could totally tank or go against you, whichever side you're playing. And then come back into your favor 80% of the time by expiration, not necessarily before. But typically when you manage your winners early, you increase those odds. So this might be 80 normally, but if you close the position, manage it early, say at 50%, which is pretty standard, then that might go up to 85%, something like that. So here's the summary, and again, ignore the bottom half or the top half. So the bottom half is a call vertical and the top half is a put vertical. The credit will be more than this actually if you're going to 30 or 40% in the money, because there's more risk in the individual sold leg, but you will still be receiving a credit, and GTC stands for good until canceled. And that's what I would typically do. But if you do that, that means it will stay on to today, tomorrow, the next day until it fills. So you do need to worry or concern yourself. If you put a whole bunch on, you need to keep track of your pending orders to make sure that they still make sense. Chances are after a couple of days, if it doesn't fill, you would want to cancel them and do something more appropriate at that time. Okay. So entering, you sell and at the money or close to the money leg, and it's going to be our call or put, and then you buy a further out of the money leg, a call or put, and obviously they need to match. So if you're doing selling a put, you would buy a put. If you're selling a call, buy a call. Because you sold the one closer to the money, that's worth more than the debit you're going to pay for the outer one, meaning overall you will collect a credit to open that position. The width defines the overall position size and the total money to be of that transaction. So the formula is the same here for everything basically. You take the width, which I typically is going to be like $5 wide, especially when you're starting, minus the credit received, so 500 minus we'll say 150, and then that equals $350 collateral. There are definitely diminishing returns here, so and that's in two ways. So the first way is if you if your sold leg is at 40% in the money, say you'll get $100, and if it's at 30, you're only going to get 80, and if it's at 20, you're only going to get $60. So you'll keep getting less and less money. That's one way. The other way is if you're widening your spread. So if you start with a $5 wide, you're going to get a better ROI than if you do a $10 wide or a $20 wide, because the bought leg is only going to get so cheap compared to the width of your strike. So if you use this calculation again, the width, so each time you increase your width, keeps going out. The credit, remember we started with 150, now it's up to 200, but we're at a 10 wide, so that's 1,000 minus 200 means collateral is 800 instead of the 350, so more than doubled. So that's a pretty realistic example of how increasing your spread, it does actually increase your odds of winning, and it gives you better break evens, and you benefit from the Greeks, which is actually my next bullet point here. You benefit from the Greeks more on your sold leg than if they're really, really close. If they're really close, they cancel each other out, basically. But the flip side there is that you're going to have a lower ROI. So you might have a higher dollar amount, but a lower ROI, which is confusing, I think, to people at first. but you have to really weigh what you value, a dollar increase or a percentage increase. Okay. So I already covered that the wider spreads collect less but benefits from the Greeks more. So as always, you'll hear me preach this over and over and over again. There's every cause has an opposite, reaction kind of thing. You have to weigh the benefits, this versus that. You're always giving up something to get something else. And in this case, you have to balance the width of the spread to accomplish your goals. So some people really love naked options, and so they're going to sell a put, but they can only afford to do that on lower value stocks. So when it gets to higher value stocks, they want to mimic that process as best they can. So they sell or they buy, say they had sold a put, they'll buy a put really far out, so they have a really wide spread. So it sort of caps their collateral a little bit. So that's their objective, but there are a million different facets to options, and you have to experiment and come up with your game plan that you think you like the most. So yeah, simple, super simple example here that we have. I think Apple's going to stay around 400. I could sell the 30% in the money put, which means since I'm selling that and it's a put, I want the stock to go up. Buying a put, you want it to go down. Selling a put, you want the stock to go up, okay? And then as always, we're going to do the 45 days to expiration. And you really want to focus here on the sold leg. I'm selling the 30% in the money put, and then I want to base which one I'm buying based on how wide I want that spread. And you can play with that number. Again, you might look at the 5 wide and then look at the 10 wide, or maybe $1 wide, and just determine, and again, weigh those. How much do you want your collateral to be? Which would be your max risk, your max loss? How much do you want the Greeks to play a role in your position, etc.? Okay, closing. As with all options positions here, you can close them early at any time. Typically for these, we're aiming for a 50%, and you need to intelligently close the position. So if you hit, for some reason, 50% of your profit target in the first day or two, or even 30%, say you get 30% after 2 days, that makes a whole lot of sense to close that position because your risk profile has now shifted. You're risking more than what you have to gain because you had such a good early head start. Chances are, if it had that huge of a move within 2 days, that it's going to sort of ease off a little bit and backtrack a little bit, and so you'll have shot up to 30% profit, and then it will slowly work its way down to 10 or 15%, somewhere in that range, before it finally starts going back up again. So you can just call it what it is and say, oh, that was a good win, and walk away with 30%. I do that sometimes. To be honest, I typically hold longer. The other facet of intelligently closing, which is what I mentioned here, is if there's only a couple days left, I personally like to hold longer, which increases my gains, but it also opens me up to more risk if something were to go against me at the last minute. Sort of the reason I play 45 to 60 days out, and sometimes even longer than that, is because I want to have ample time to be profitable on that position. And when you're playing a super short position, say 30 days, there's just no wiggle room. If something goes wrong and the stock tanks and you were in a bullish position, the stock tanks, even if it does start to recover, it might not recover quick enough to make it up in that 30 days. So I like to give myself plenty of time, and the side benefit of that is then you'll collect better premiums and get better strikes because the percentage in the money, the further out you go, the more range of strikes that stock could hit. I should actually show that in another video. That's a real tip. Quick tip here is in Thinkorswim, you can add the indicator for just type in the word cone, C-O-N-E, and it will do a probability cone for you. Okay. Yeah, and you only want to hold it longer if the position is still good and you think you still have faith in that company and their trajectory. Obviously, if things are looking poor, why would you hold it any longer anyway? You would want to close out that position. But no matter what you do, you should definitely manage it before, like the week before expiration, because your risk of assignment jumps way up in the last week, and you to eke those last couple bucks out, you would need to wait till the last week anyway. Like basically, no position is going to go below $15 of value until the last week, or even the last day or two. So you might as well, once it gets to around 20, just close the position because it'll come down and tap the $20. I'm talking the remaining value left in it. And as sellers, we want it to go to 0. So it will come down to 20 and then you'll see it pop back up to 30 or 40. So if it ever hits 20, 25, I mean, yeah, you should definitely be getting out of that position. Yeah, so I'm going to take a break here and go over to Tastyworks and go ahead and show that right now I've got the small account challenge. If you're following me at all, you know that I love these positions. It's basically all I have on at the moment except for 2 SPY long calls, but everything else are short puts here. So I can just expand these. You can see, and again, these are all on my small account challenge, so feel free to use those. But yeah, these are all short puts, which again, short just means that I sold them. So to open them up, you simply pull up your ticker that you like. SE is fine. Go to strategies, and then we'll go to short call. Make sure vertical is selected here. And you can default which one you want to be favorited. So I have short put, and I can just hit go over here, or I could have hit it over there. And it automatically did a $5 wide for me. However, it put the percentage in the money at 9%, which you can see is a terrible credit. Of course, this is not during market hours, so this will change. I will say I'm not personally a fan of setting up orders and letting them on. So like doing this after hours, like on a weekend or a weeknight, unless you put the price really high, because the next day the stock might go through the roof or it might plummet, and now you're stuck getting something that's no longer a good idea. I hope that makes sense. But so I would typically go around here, and then I'm going to play with the numbers. So I like 40%, which gives me 180 credit. Let's go ahead and see 45. That only gives me $17 more, which hardly seems worth the increase in risk. But going between 35 and 40 is $66. So that is a huge difference, whereas it's $17 one way or $66 the other way. So I'm definitely going to hit the 40%. You could also check the open interest here, just to make sure people are interested in this. You can see for whatever reason the 124 strike isn't very popular, and you can also check out volume as well. And look at that, the 2 strikes that I have are the most popular, and a lot of that probably has to do with them being 115 and 120. So people like the divisible by 2s or 5 kind of numbers, just the nice even numbers that people are used to seeing. So that does actually make a whole lot of sense. So anyway, there we can see, oh, this is actually 6 days to expiration, so I goofed up and I didn't push the expiration first. So let's go out to the next monthly, which is September, and let's do that again. Okay, so here you can see the 110 is 36%, but if we went back to the original one we were on, the 110 is a 6% chance. So the odds of any strike getting hit further out in time is greater, obviously, because you're allowing more time for the stock to move around. Another way you can do it here is to click on the bid column that will sell it, and then click on the ask column, and that will buy it. So right now that's saying 202, so we can even get a better gain of it by going, now the other one was 40%, but this is 44%. So given under these circumstances right here, I would probably just go with the 115, 110 and collect 2 or 3. That's pretty good. And then we'd have a 48 days to expiration for September. Okay, and one last thing, we can look at the pop. That's 59% success rate, but if I close it at 50%, then it jumps the whole way up to 67%, according to them. Okay, so let's go to, we'll do the same thing here. That was SE. So over here in Robinhood, it is harder. Doesn't matter if you're doing mobile or their desktop. I still think it's harder to do. So first thing I'll do is switch to put, and then again make sure I'm on the right expiration, which since I built it over here, I can remember right away. It's 9/18. So I have the 9/18 expiration, and I decided I wanted to do the 110, 115. So I'm going to go ahead and sell the 115. I think it's easier to do the inside legs first, which are sold, and then the 110. Okay, and that's saying now I can get 2 or 3, and that's saying I can get 2 or 3 as well. So a lot of times people will rag on the fill rate for Robinhood, but it may or may not be the case. I think it's often the case where I have to come down, like I probably would have to come at least down to 200 to get filled. And you can look at the chart down here, and I might even have to come down to, you know, something like 195. Whereas people over here on Robinhood, they're not used to, it's really about how quickly do you want to get filled, and they're not used to having to adjust the price. So yeah, when you're here, you could say 1 contract, and then you could just go ahead and put 2. And a lot of times, it depends on the ticker, but you're required to do in $5 increments anyway. So right there's a good for cancel, good to cancel, or good for the day, and then I can go ahead and hit review order and fill it there. So almost the same process. I just think it's a little bit more clicking and less intuitive, and you can't see any of the data associated with it unless you click on the strikes, and then we can get the delta down here and see that the delta is 35, whereas over here the percentage in the money is 44. So they are not 100% equivalent. Delta is over here in Tastyworks as well, but here they don't have the percentage in the money. So yeah, take that for what it's worth. Okay, so let's get back into it. Okay, so clearly the biggest risk and most common risk is blowing through the strikes that you sold. And obviously that depends on whether you're doing a call or a put side. But the good thing here is because we're only doing one side, unlike an iron condor, you're only doing one side here. So if you're choosing a stock that has been going up and has that momentum behind it, chances are it will continue to go up. So it's a little bit less risky in my from my perspective than an iron condor, where it's got 2 sides where it can collide with your sold strikes. You can always choose safer in the money, like a lower percentage risk, but again, that's weighing how much your risk to reward is. You can't just sell 97% in the money, or rather 3% in the money, which would mean that 97% of the time you would win, because you will receive so little credit there, and there probably aren't that many buyers there, or those buyers aren't willing to give you much, that your risk reward is way off. So yes, you might win 97, but literally that one will completely wipe out all of your gains. Not to mention that you have a lot of money tied up in a low profit position, and so your ROI is going to be horrendous anyway. So don't bother doing that. Okay, one thing you can do is ensure your sold leg is below a support. Again, if you're doing a put side, if you're doing the call side, obviously, then it would be above a resistance. And don't play earnings, because earnings are so dangerous. Doesn't matter what the stock does, whether the company does, what they could beat, and it could be an expected to beat, but the market isn't happy with that, and so it will still go down. So they're totally random. Where possible, I don't do anything with earnings in the next 30, 40 days because I want to be sure that I can get in and get out. Typically my position's around 15 to 20 days, but certainly sometimes they last way longer than that, and you can't predict that going into it, so I want to make sure I have ample time before earnings. The stock can land in between your bought and sold leg, and it gets funky, but again, managing your winners early or even your losers early, closing out of that position before the week of expiration will make your risk of assignment way, way, way dramatically less. I can tell you I basically never get assigned. I did get assigned a bunch of times during the COVID crash, but then because I'm doing spreads, I was able to exercise the other side or sell the stock with the other option and close things out. And it's right around what your max risk is. There's usually a little bit extra there because of the fees or whatever, but it's right in that ballpark. Okay, so you can get assigned on any sold leg. That's in any strategy, but I have another video about it, and it's not as scary as most people assume it to be, and you're not going to go broke because of it, especially doing spreads. That's the whole point of doing spreads. Rolling is way less of a pain. This doesn't really belong on the slide, but rolling is way less of a pain compared to iron condors because you can do it all in one transaction. So you close out your two older legs and you open up two newer legs, and whether you're rolling down or up in the same expiration or whether you're rolling out to a new expiration, either way can be done in one order, which makes that process a whole lot easier. It's still certainly not as easy as a naked option, but it's definitely pretty easy to do. So I have a small note here. Unlike naked puts where you really can't lose because with a naked put you already know what, so say it went against you and that option got exercised, you would just be buying the stock at that price and then you could sell it later on, assuming you're doing it on a good company, which you should be doing. Whereas naked calls, technically they could go up to basically anything, and you could really be in a lot of pain doing that. But unlike naked options, these can go to zero, and you probably don't have enough in your account to cover purchasing the stock. That's why you're doing the spreads. And so I think there's a little bit more risk involved actually than naked options, and it's hammered home by a lot of people who don't understand what they're talking about, that naked options are more risky than anything, than spreads or whatever, or just buying a call or buying a put. In reality, though, naked puts are probably one of the safest options. These spreads can go to zero because you're not going to have enough money in your account to purchase the stock, and so if things go south, you accept that loss. And so you need to have that mindset going into it that whatever your max loss is, you're actually willing to lose. People can say that a million times and you don't really truly consider it until it happens to you. But we all lose. That's part of the game. Your obvious goal is to lose less and to make sure that you are overall making money. But we all lose at some point in time. So accepting that that's a possibility and that these could go to zero is paramount. And this these are really the risk-defined versions of selling naked. So selling naked options is like the purest form. You'll hear a lot of the old timers talking about the purity of selling naked options, selling a call, selling a put naked, and you need to have a large account in order to do that. So us smaller folks need to do spreads, and selling spreads is the alternative, the risk-defined version of selling naked. So if naked is the ultimate best route to go, and this is the sibling to that, that's one more indicator that that's what I should be doing. So yeah, just you can think about that for a second. Okay, so when it makes sense. I kind of reuse these titles from the other presentation, so yeah, bear with me. But anyway, if you choose a side with a bit of a buffer, it enables you to benefit from theta vega and the price movement. So unlike the Iron Condor, you can't benefit from price movement, and buying calls or puts, you can't benefit from the passage of time or the decrease in volatility. Of course, buying options gain value with increased volatility, but typically things don't stay at an elevated volatility rate. So you're going to have spikes of volatility and then they come back down. So instead of trying to anticipate when a future spike of volatility will come up, it makes more sense that when volatility is high, you sell something to capture that increased premium, and then you can always count on volatility going back down. So, I mean, just look at VIX. It spiked up huge with COVID, and it's already way down. It's close to. It still has some room to go, but it's close to being back to where it was prior to all of that. I will say with this, I think it's best to stick with the motto that the trend is your friend. Don't be arrogant and assume that you can call the top or the bottom. I think that was my biggest hang up getting started. When I started, you think you're a genius and everybody else is idiots. And clearly, this is the top. It can't be. It can't go any higher than that. And all the stars align. You see the picture so clearly that you are right, and you can't believe nobody else is calling it what it is. So what did I do, and what does everybody else do? They put all their money. They make a stupid bet on that the market is going to take a turn down, and it probably will at some point turn down. But will it turn down within the time before your expiration? Will it go up another 20 points before it then has a turn down? Because if you open your position right now and then it goes up 20 points, even if it comes back down 20 points, that's a huge drop, but it's still back to flat to where it is now and not down where you said it was going to go. I hope that made sense. The point is, if you go with the trend cautiously, I'm not saying dump all of your money like an idiot either, cautiously enter, slowly enter in positions. When I first got started, it was like literally one position a week because that's all I could afford. But obviously, as you start building up your momentum and your steam and your account gets bigger and bigger and bigger, then you actually do get to trade multiple trades a day. So I know you're anxious to get started and throw a lot of positions out there, but the reality is you should enter in slowly, cautiously. That way your positions are with the market. As the market's moving up, you've got some position, and then it moves back down. You've got some more positions at that point. And so you're really diversifying your entry instead of throwing it all out there at once. I do think right here I talked about high value stocks, high dollar stocks. Totally makes sense. Something like Amazon, you can't sell a naked put on Amazon unless you have an insane amount of money that you want to dedicate solely to Amazon. So yes, I could sell a put on Bank of America naked, and that would only be a couple $1,000s collateral, like $2,500, something like that. So that's something that we could afford, right? But if you want to play Amazon, which I don't think anybody would argue that Bank of America is a better company, more profitable company than Amazon. So if you want to play that better company, Amazon, you need to leverage spreads in order to cap your total collateral. Otherwise, you're going to consume your entire account and risk your entire account on Amazon. What if they have a bad month and it goes down and now you're getting margin called and you don't have that money? So just do spreads. It caps your potential risk. It obviously caps your reward, but selling by nature has a capped reward. So overall, it's a better use of capital. I would rather sell 10 spreads than do one naked. I don't think that will ever really change no matter my account size, just because I'm a ROI nut where I want to make sure that I'm being as efficient as I can with my allocation and my income. Yeah, so most of this I've already covered already. I love theta and vega, just knowing that sitting there, I'm making money. Whereas a call buyer or a put buyer sitting there, they're sweating bullets because every second that passes, if the stock is not moving in the direction, they're losing money and I'm making money. So that really puts a smile on my face. I also love that you can choose further out. You can choose what risk to reward you want. So something like Apple, if you're following along on my small account challenge or my pro alerts, you'll see sometimes I'm doing 50, 55, 60% chance in the money, which means that would have a 40% win ratio, win percentage on Apple because of how bullish I am during certain points in of time. You know, if they've had a strong downturn, yeah, I put on some pretty heavy risk spreads, and they've turned out fine because Apple's hitting it out of the park. So. But anyway, the fact that you can choose that is much better compared to buying or shorting a stock. It doesn't matter which one you're doing. You've got a 50% chance of being right. You're buying stock and the next day could go down and you can't control it. But with options, I can say, I don't want a 50% chance. I want an 20% chance. And then you can build your strategy around that. I do think it's more fun. So obviously there's a part of options that are a little bit gambly, a little bit entertainment. And so let's just call that what it is. And picking a side is more fun than trying to be neutral. So although when I got started, I liked the idea of maintaining neutrality. I don't care which way the market moves or this ticker moves. Ultimately, it's more fun for you to be a bull and sit on the sidelines and wish the company well, wish the world well, and be optimistic. So you can play these, like I said, doing a credit call spread bearish. That would be a bearish position. And I do those sometimes, but honestly, I'd rather just hold money in cash or own some stock or something like that than put on a bearish position, because the longer and longer you do it, it feels dirty almost. And I don't think there's room for bearish positions in a bull market. And I would say that on the flip side, in a bearish market, it doesn't make sense to have bullish positions. Either have positions on that are going with the trend, or have the extra money sitting in cash. So right now, I believe we're in a bullish market, so my positions are bullish. Okay. I already said they're like pure options. I like selling, just generally speaking, because you get a better break even than what your strike price is because you collected that credit. And so you can win 2 out of the 3 scenarios. 3 scenarios being stock goes up, stock stays the same, or stock goes down. And actually, it's like 2.5 out of 3 scenarios, because we always build a buffer in there, or most of the time we build the buffer in where the stock can even go down a little bit, and it will still be above our strike prices, and we'll still win. So it's like 2.5 scenarios out of 3 we can win on our position, compared to the buying a call or buying a put, which has a even worse break even because you paid that money, and it only works if the stock goes in your direction, and it goes in your direction big. Okay. So same general recommendations for all of these. Basically, you choose a stock you like. It's got to have a trend that matches the type of position it is, but because we're talking about verticals today, it could be a flat up or down, and you can accommodate that anyway. So a flat trend, you could choose your side, although I would choose to sell puts there. If it's going an uptrend, you would sell puts. If it's going on a downtrend, then you can sell calls. One other interesting thing to think about here is if a stock has been going up and up and up and up. So, I'm thinking about Apple there, or Shopify. People are, again, contrarians, and they think they can call the top. So the premium on the puts are much, much higher. So, and you can basically find buyers right away because they know that shop is going to go down. Well, I couldn't tell you how many shop positions I've won in a row now. Of course, knock on wood here. But if you're selling calls, the only ones buying those are the buyers of calls believe the stock is going to go up. So you may or may not have trouble getting those filled depending on the ticker, but there's almost always somebody willing to bet that X and Y, Z company is going down, and they're going down hard tomorrow. So that's just one other thing I can typically get filled and get great premium on Shopify, Apple, Amazon, because everybody is gunning for them to go down. Okay, obviously options you want to be liquid, so the most liquid of anything is SPY, but the large name companies are also very liquid as well. And I'm typically going out 45 days or whatever is the next monthly expiration around that time period. So right now that's August, which I think is 49. I need to update my slide. And so an example here would be AMD's trading around 76. So I'm going to sell the 72.5, which is around 40%. Then I'm going to buy the 67.5, that's a $5 wide spread, and I'm going to get 155 credit, which is right what I'm aiming for. I typically actually like to aim for 160, but I would totally accept 155. That's perfectly fine credit. And again, that gets us right with the around 350 collateral, 345. There's a bunny outside. Okay, conclusion. In most cases, I think it makes most sense, and it's easier than trying to identify a top and a bottom. So with an iron condor, you need to say, where do I think support is up down here, and where's the resistance up here? Doing so will give you the best odds at winning your iron condor. Now, if you can pair that up with good percentage in the money, that's even better. If you can pair that with an SMA, that's even better. But the more factors you can get to identifying your top and bottom is better. And with doing these verticals, you only need to identify that on one side. So I'm just saying there it's quicker. And then in my opinion, verticals are the best way to get started with options. They are the lowest risk way to get started with options. You have a very clear number of what the max profit is, a very clear number on what the max loss is. So some of the nice things about a covered call and a wheeled strategy is that there's these clearly defined rules. But when you're buying calls and puts, people always say, well, what do I close it at? And that's sort of impossible to say. It's hard to set up an automatic order unless you just have some magic number in your head, 20%, because there are too many factors involved, and brokers don't typically let you put in to say close this option when the stock price hits X and X amount, right? So typically they let you close that option position when the option hits such and such a value, but not when the stock hits such and such a value. So then you're just left saying, oh, I think I want 10 or 20% off of this position. Oh, I think this position can go to 100%. Those kind of things. Well, with a vertical, you have those variables up front. So you collected 150 credit and you want to close it around 50%. So we're going to call that $75. And so I'm going to automatically set up my closing order for $75. And I can keep an eye on it. And then maybe if things go poorly, typically I wouldn't recommend managing your losers, but if that's something you're into, that's fine. And you could say, well, I know my total potential loss is $350, so when I get to $200 lost, then I could close out the position. And you can do all that because those are all known numbers. So I think there's a lot of benefit to that, especially for beginners. It takes a lot of the guesswork out of it, and it helps you make more steadfast rules, which then again, as you get more comfortable with, you can break and adjust those rules. But at first, it is good to be real stringent. So yeah, in closing, I got the links in the description like everybody else. Leave a comment if you could, and share and subscribe. Obviously, that helps the channel, and comments help me understand what videos I need to make and how I can make them better, that kind of stuff. I got lots of videos planned. Tasty Tracker is my website. It's free, helps you track your stocks and your options, as well as share those, and other people are sharing them, so you can learn ideas from them, get some experience there, and you can follow my trades real time for my small account challenge. And then if you're interested, you can pay for the alerts on my other accounts, but everything else is free, so you don't have to feel pressure to pay or anything. And then these are all just my opinions. So anyway, let me know if you guys need anything, or if you have any questions, let me know. Thanks, guys.